Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known by many of you as Mr. Valuation. With today's video, I'm going to do a follow-up on a video that I did in July that was requested by subscribers to the channel on Alibaba, the Chinese Amazon, if you will. And I went through a nice fundamental review of the stock at that time. And I also talked about what I called the political risk associated with the stock. Fundamentally, I think it's one of the most exciting companies on the planet. Politically, that's a different story. Investing is a complex thing, as we all know. But yet, to me, it's always been a lot more about common sense than it is about a lot of sophisticated algorithms or, a lot of what I would call, fancy fundamental financial formulas and so on. It really comes down to you want to invest in a great business. If you're investing for growth, you want to invest in a fast-growing business. If you're investing for income, you want to invest in a business that's generating consistent income. And whatever nuances, around that is what you're investing for. Now, Alibaba is a growth stock, and it's one of the fastest growing stocks on the planet. And of course, it's the Chinese Amazon. It primarily works in the Chinese marketplace, which is a huge and growing market. It has enormous potential. But it does have a problem. It does have some political issues that investors need to be aware of. And I think that complicates investing in Chinese VIEs, they're called. I'll get more into that here in a moment, than it does just investing in, let's say, Amazon here in the United States, a New York Stock Exchange listed publicly traded company, or at least a U.S. exchange listed publicly traded company. Now, I want to go back and revisit the video before I get started on Alibaba here. So let's go ahead and get into Alibaba right now. Let's look at the graph, the fast graphs as it sits today. And then I want to compare that to what I did in July. So first of all, I want you to note that this is a very strong grower based on earnings per share, which is what I have up here. And you can see that the stock is extremely undervalued. The normal multiple of this stock has been about 32 times earnings. I'm going to switch this graph to operating cash flow because I think that's also another aspect that I want to look at. This company also generates very strong operating cash flow. So you have a very similar picture here between the two. But here's the point. If I go back into looking at Alibaba on the July 14th, 2021 video that I did, I want you to notice a couple of differences in what you see today. Very similar picture. Back then, Alibaba was trading at $209.51. Okay, today, the stock is trading at $144.20. Earnings estimates today are $9.23. Back when I did the first video, earnings were expected to be $9.71 for a negative 2% growth rate in fiscal 2022, which, by the way, ends in March, just so you're clear on that. So, we're already into the 2022 fiscal year here. And the reality of it is that's a significant drop. Today, we're expecting a 7% earnings drop. Now, there's some issues about that I think are important, that are political and so on. Is what the primary involvement is, has to do with certain companies, IPOs that Alibaba and Jack Ma were trying to basically launch that were essentially rejected by the Chinese government, et cetera. So there's political risk here. I think that's the real key thing. Now I'm going to move this video up to about 6 minutes here on the old video I did. And I also want you to take a look at forecasting, because forecasting is another thing that's changed dramatically. Back when I did this first video, again, back in July of 2021, analysts were forecasting, as I said earlier, 971, 1207, and 1458. If I move this back a little bit, perhaps, or maybe, yeah, there we go. They were also forecasting about 14.2% growth for this fiscal year, with a minus 2% growth followed by 24%. Today, if I go into forecasting and look at Alibaba on the same basis, we're looking at 923 and 1109 for an 11% growth rate. So the growth rate has dropped from 14%, the near-term growth rate, to 11%. Now, what's interesting about that is with the recent drop in price down to 144, Alibaba all of a sudden looks like it's reasonably priced relative to that growth. And if that ceteris paribus, all other things remaining constant, or maybe that's a bad analogy. If the Chinese government was taken out of the picture altogether, maybe it'd be a better way of saying it. I think this would make this look like a very, very attractive investment. If I look at, forecast growth for the longer term, it looks like, currently analysts, and there are 3 analysts that are from FactSet, which is where we get our data, are forecasting 15.6% growth today. If I go back to the video that we did in July of 2021, the forecast growth was for 25%. So once again, we have a significant change in what the prospects in the future of this company are. Now, if everything on this graph turns out to be accurate, even with these adjustments downward, and the forecasts continue to be accurate, this would make Alibaba now a true value stock. In fact, there was a recent article on the website Seeking Alpha that talked about Alibaba was now a value stock. I would call it a growth at a reasonable price, assuming this was nothing more than market overreaction or hype. Okay, but what brought all this to my attention, the reason I wanted to review this video, all had to do with an article that was in the Wall Street Journal over the weekend, and it was called "The Countdown Starts on Chinese Company Delistings After Long U.S.-China Audit Fight." And here we have, Gary Gensler, the head of the SEC, talking about they're working on details of how Holding Foreign Companies Accountable Act will be implemented. Now, what I did was, for convenience, I took this article and I copied it and put it in a Word document because I want to go over some of the things that concern me. You can check the article out yourself in the Wall Street Journal. And it was published October 2nd by Don Lin and Yin Yang in Hong Kong, in New York, and Don Lim in New York, and Yin Yang in Hong Kong. Okay, and he wants to hold foreign companies accountable. The head of the SEC does. Okay, and what the reality of it is, I've highlighted some things here that just really troubled me as I went through this article, because at a client's request, I do have a small position in Alibaba for one client. Personally, I'm reticent to invest in these international stocks, but I'll get into more of that here in a few moments. But the point is, the SEC expects U.S. regulators could flag Chinese companies in 2022 if they don't get access to audit work involving 2021 financials of those companies, okay? And so, some investors anticipating this potential problem have started exchanging their American depository receipts, which is the only way you can, invest in the United States as a U.S. citizen in these Chinese companies, for shares trading on the Hong Kong Stock Exchange, which is a little tricky, and I'll get into that a little bit more in detail. Okay, but the bottom line is, as the article went on to report, we see liquidity moving gradually but consistently to Hong Kong over the next couple of years. So any of you that are holding the ADRs, as I am, might have a day of reckoning coming that you would need to take some action with. The problem is the stock price is pretty low right now, and most everybody would show a loss if they were to liquidate their Alibaba shares rather than convert them. But nevertheless, the bright side of that is that they also believe that data shows that most trading still occurs in these Chinese ADRs rather than on the Hong Kong exchange. But again, the problem is that could change because U.S. regulators said they never got the transparency they needed into the work of auditing firms on Chinese companies because China wasn't routinely handing over the papers they needed for negotiating in good faith. Now, that's very interesting. Like, there was Charlie Munger, for example, Warren Buffett's partner, was on record saying people worry too much about the lack of transparency on Chinese companies. China is a huge market, and that is something that needs to be considered in this discussion. And the growth potential over there is enormous on the long run. Okay, but you do have the Chinese government intervening, even though, it opposes politicization of securities regulation, and it welcomes dialogue to find a solution. So, there is hope that the U.S. and the Chinese government could get together. In 2015, both countries met in Beijing to try to establish protocols. After 2 weeks, the talks broke down. One deal breaker: Chinese officials weren't willing to let the U.S. inspect the audit papers precisely of Alibaba and Baidu, two of the most valuable Chinese companies listed on American Stock Exchange. Now, I'm not sure how to pronounce that. Shaswat Das, the PCAOB's chief negotiator, said he understood from prior talks that access would be granted, and took their response that they needed to consult with other ministries as a sign that they weren't negotiating in good faith. The Chinese side had expected the U.S. to eventually come around to regulatory equivalence, which is an arrangement that China does have with other international groups like the European Union. It basically means that China would accept the work done by the Chinese regulator as if they had done it themselves. Now, unfortunately, the U.S. says that's not acceptable, okay, which is, kind of interesting. So there's kind of a stalemate there. So in the absence of a resolution, the Holding Foreign Companies Accountability Act was introduced in March of 2019. The proposal was seen as imposing critical limitations on the PCAOB's ability to conduct inspections, according to the oversight letter. Now, around the same time, to add, fuel to the fire, we had this Luckin Coffee, an upstart rival to Starbucks, admitted to fabricating revenues expenses, which cast even more doubt on the credibility of Chinese accounting and whether these ADRs were producing, good records based on all this controversy I've been sharing out of this article. Now, in June, the Senate passed another bill that, if enacted, would shorten the 3-year timetable for delisting to 2 years. So it's getting imminent. In other words, it's, this looming threat of delistings gives the U.S. officials key leverage on the negotiating table against the Chinese, this is an opinion now. But if the U.S. is going to have any success in the negotiating table, this legislation has to be implemented, said Mr. Doss, who is now a lawyer at King & Spalding, LLP, in Washington. So there you have it. There's obviously a lot of issues. Now, by the way, if you're not familiar with who the PCAOB board is, it's the Public Company Accounting Oversight Board, okay, which is a nonprofit organization that regulates auditors of publicly traded companies. The purpose is to minimize audit risk. So that's really what they're trying to do. Okay, so another issue, I think, with the Chinese, investing in Chinese VIs is that you also have to recognize, there was an article in the Wall Street Journal over the weekend by the Asian investor, the gentleman goes by, that I thought was very interesting. And he says, he said he was wrong about Alibaba stock. He said that, he had, invested in it, but he brings up a very important point. He says, common prosperity. He says, no phrase scares the living hell out of non-Chinese investors more than the phrase of common prosperity. The concept of a shared prosperity or redistributed wealth has deep roots in China's political life and culture, and the Chinese Communist Party uses it as a justification for a widening crackdown on the economy in 2021, which is also, by the way, part of the angst that's causing these Chinese stocks almost across the board to be dropping now. And they have targeted financial institutions primarily that offer cryptocurrencies. In fact, I understand they've banned them. E-commerce businesses, which of course is Alibaba, and ride-hauling companies, education enterprises, to name just a few. So there's, a real issue there. Okay, now I do want to talk about this thing. I told you I went about the variable interest entities, or VIEs, that are what are the basis for trading in Chinese ADRs. Technically, you are not allowed to own shares in a Chinese company as a U.S. citizen. Now, you've done it through these variable interest entities that enable Chinese companies to raise money. Okay, now what these really are, they're contractual obligations, if you will, that allow you to, have certain contractual calls against these Chinese businesses, but you technically don't own them, okay? So they're companies that are controlled via a series of contracts to affect ownership, but not direct ownership. And of course, Alibaba, this is another article, it was in the Wall Street Journal on September 30th, that talked about the risk of investing in these ADRs. Now, there was another article, this is a rather old article, a couple of years ago, that talked about fungibility and what the big deal with Alibaba's fungible shares on the New York and Hong Kong exchanges. Essentially, all this article is saying is that these shares are fungible, meaning that one transfers fluidly into the other. But again, that's even something that could be a possibility. But the bottom line is there are people that are moving into Hong Kong, but investing in Hong Kong, I came across an article in Benzinga that talked about how to buy stocks in Hong Kong. And, it is a little tricky. Now, you can do it. There are, U.S. stock brokerage firms. I think the big one was Ameritrade that they talked about, Interactive Brokers, that you can go and buy, Hong Kong shares directly on the Hong Kong Stock Exchange. But I think there's even restrictions on that. And I'm not an expert in that, so I don't want to, hold myself out as an expert. But the bottom line is, investing in these VIEs is not the same as owning the companies outright. So the bottom line is, if you look at this from purely a fundamental point of view, I do believe that the potential long-term growth is extraordinary. I do think when you consider, how far this stock has dropped, again, back in June, it was 220. When I did the article in April, it was 230 or 240, and it has fallen substantially even more. As I checked the last time I looked today, it was down about 3 to 5% today, actually 2.86%, as I'm producing this video right now. So there's, an awful lot of pressure, but you can go across the board with these Chinese stocks. The point is, I just don't really know what to advise anybody. The reality is, if you're willing to speculate, Alibaba is extremely cheap right now. If all these issues that I've discussed in this video get resolved, this thing could be a screamer. But there's an enormous amount of risk here, because if it was actually, if the ADRs were considered defunct, they weren't allowed to trade anymore, you had to, get out of them, you're certainly going to take a loss. So the question is, how much politics really has to play here. The reality of it is, if you're looking at standard investment principles, buying value, investing in great companies at sound values, etc., Alibaba would check all those boxes, low amount of debt, A+ rated, fast growth. Even at these lowered numbers, this company still has enormous growth potential, but you're dealing with risks here that are outside of what I would call normal fundamental investing. And so I wanted to update everybody on where it stands at Alibaba. I'll be quite candid about it. I am very concerned about this stock now, not the business, not the company, and not its future. It's whether or not we as U.S. citizens will be able to participate in that growth, at least through the ADR, concept that it currently trades at, or the VIE, the variable interest entities, which, are very, very nebulous. They're simply contractual obligations, and those contracts can be violated. And the problem is, it'll be the U.S. investor investing in these ADRs that's caught holding the bag. Great business, great company, huge market. It has all the attributes of what you'd want to invest in. But I guess the key thing is that what you want to do today, perhaps, should I invest in Alibaba? And I'm going to switch to operating cash flows here so that I can show Amazon when, which is the Chinese Amazon, when I can invest in Amazon right here in the good old US of A, where, and if I look at it not from earnings, but from a point of view of operating cash flows, Amazon looks extremely attractive at these levels, and it has, very significant growth expectations going forward. The reality of it is, it's a little pricey for the next couple of years, perhaps, but longer term, it looks real good. If you look at it trading on its normal multiple of 20 times, 25 times cash flow, Amazon would be very cheap. So the question is, do you want to participate in the e-commerce business through the Chinese ADR Alibaba, or would you rather do it through the U.S. here in Amazon? And I'd vote for Amazon. Anyway, I just wanted to bring you this update. I hope you enjoyed this video. There's a lot of political issues here that, again, go beyond traditional analysis that I think investors need to be aware of. This article that, came out in the Wall Street Journal this weekend is what really instigated me to go ahead and bring you this updated video. I hope you enjoyed it. I hope you got something out of it. If you did, give me a like, ring the bell, and subscribe to the channel for more videos like this. Anyway, I appreciate y'all. Thanks for watching, and I'll be talking to you again real soon.